Today's pick number 1 is SRTY, ProShares UltraPro Short Russell2000. SRTY is designed to provide 3x inverse exposure to the daily performance of the Russell 2000 index. This means that if the Russell 2000 index goes up by 1% in a day, SRTY aims to go down by approximately 3% and vice versa. But before examining the reasons why SRTY appear to be oversold, let's start with the basics to ensure we're all on the same page. The Russell indexes, created in 1984, help investors understand how different parts of the US stock market are performing. Among them, the Russell 2000 stands out because it tracks small companies, typically valued between $300 million and $2 billion. These small companies are important to watch because they can grow quickly and are a good indicator of the domestic economy's health. So, why is SRTY oversold? A significant reason is the Russell 2000's strong performance, particularly in the financials, industrials, and information technology sectors. The financial sector has benefited from rising interest rates, which can lead to higher profit margins for banks and financial institutions. Meanwhile, optimism about economic recovery has boosted both the industrials and information technology sectors. As these sectors within the Russell 2000 thrive, SRTY, which inversely tracks the index, tends to lose value, leading to its oversold status. Today's pick number 2 is CAR. The Avis Budget Group provides vehicle rental and sharing services globally. CAR is considered oversold due to a combination of factors, including operational challenges like increased fleet costs and reduced revenue in the Americas segment, alongside industry-wide pressures from the growing car-sharing sector and economic hurdles such as rising interest rates. These elements have contributed to a bearish outlook, with the company's latest earnings report revealing a significant year-over-year decrease in net incomes and concerns over its long-term profitability and competitive positioning within the car rental industry. Today's pick number 3 is AMCX. AMC Networks is considered oversold due to a combination of its financial challenges and market performance. The company experienced a significant revenue decrease of 12.42% in 2023 compared to the previous year, alongside a 23% drop in US advertising revenue and a 30% total revenue fall in the fourth quarter, which impacted investor sentiment negatively. Despite an earnings increase, these declines led to the stock's valuation being questioned. However, some analysts believe the heavy selling pressure might have been exhausted, and with Wall Street analysts raising earnings estimates, there could be potential for a trend reversal. Today's pick number 4 is SSRM. SSR Mining specializes in finding and processing valuable metals like gold and silver. Right now, its stock is seen as oversold, suggesting it might be cheaper than it should be. Despite doing well by increasing its gold and silver output, there are bigger worries at play. High interest rates set by the US Federal Reserve to fight inflation make borrowing more expensive. This can slow down economic growth, making safe investments like bonds more attractive compared to riskier ones like stocks. For companies like SSR Mining, this means their stock price can drop as investors look for safer places to put their money. These broader economic concerns, coupled with the Fed's plans to keep interest rates high, make investors wary about the future, leading to the stock being considered oversold. Today's pick number 5 is ALNY. Alnylam Pharmaceuticals develops RNA interference therapeutics for genetic diseases, cardiometabolic, and hepatic infections. The perception of ALNY being oversold likely stems from its recent earnings report, where the company disclosed Q4 revenue that was slightly below expectations, alongside a non-GAAP loss per share that matched analyst predictions. Despite reporting a year-over-year increase in revenue and a narrower loss compared to the previous year, these results fell short of the consensus forecast, leading to a significant stock price drop of over 10%. This reaction could be seen as an oversold condition, considering the company's ongoing strategic collaborations, a strong portfolio of marketed products, and a diverse pipeline of investigational therapeutics, which collectively represent significant future growth opportunities.